Hey everyone, Dave Putz here from JKP Holdings. Good afternoon. Always aside me, Mr. Nathan Turner. How are you, sir?
Hey, very good. Thanks. How are you doing?
Good. Hopefully the weather is kind of being a little bit better for you guys. We're getting like 60-degree weather here. Kind of impressed right now.
It's been above freezing just the last couple of days, where we discovered we've got a little bit of a leak in our basement. So we're trying to figure that. Once it warms up and we can dig, it's an easy fix. But anyway, we're having to deal with that right now. Lots of fun.
Yeah. So hopefully things are working out. Things are kind of turning in. For those who don't know, DMA is around the corner. There's a couple more conferences. Our due diligence portal actually has a list of all the conferences coming up. So definitely take a look at that. This is being recorded, it'll be on YouTube. And I'm telling you, the pre-gaming talking, I guess the green room is they talk on TV. We had some cool topics. This is gonna be a fun one with Joe. He
nailed down one more for us at the end of March. So we'll talk about that later. I don't want to give it away, but it's gonna be good.
We have a bunch of stuff coming up. I'm sure you see the feed in the Facebook events. We have a bunch of new topics coming up on Fridays and be cool. So Nathan, I know we were talking offline as well. You're submitting some offers. We're doing some offers too. Things are kind of opening up a little bit. Winning some bids, buying some partials, selling some deals.
I got in contract
on early.
Yeah, I went into contract on 2 last week. I just I got my due diligence back actually just this morning. I'm supposed to be closing today. BPOs are not fantastic.
Ooh.
And so I'm actually debating or negotiating, I'll say, with the seller right now, or seeing if we can do something a little bit better on their pricing, because that's with I know you're not a huge fan of BPOs, but with the values that I'm getting versus what they think it's worth, we're not on the same page. So we're trying to figure that out. But some other bids in aside from that as well.
So is it the fact that the values of the area are bad, or the house itself is not good condition?
The house itself. Yeah. One, there's some damage to the house, and we already knew that. Last July, they got a valuation of 80,000. Today I'm getting a value of 50. So that's a big difference. And so we're in negotiation, and we'll see if that closes or not. But and what I tell people all the time is, you don't try to make the numbers work. Don't try to force something that isn't going to go, because you'll be sorry.
Don't get emotional about it, right?
No. And there's always another deal. And if you need to pass on this, as much as I want to keep the relationship, and it won't damage the relationship in this case, but don't try to force something if it's not there. That's kind of what I'm getting at.
Joe, can you give us a background where you came from, real estate wise? How did you get into notes? How did you come across this crazy thing? And what was your learning curve? What was your background?
Sure. Well, I came from my mother a long time ago. After that, I had a corporate career. I spent about 30 years doing oil and gas finance, international operations. And so I actually lived all over the world doing finance for oil and gas operations. So doing project economics is a very familiar thing with me. We would do that for all these different projects, all over the world. So that part of it was, when I left the corporate world, it was kind of just intuitive for me. And so I had invested in real estate in the early 2000s, mostly rentals, that kind of stuff. And then I heard about notes, and I thought, well, it's kind of interesting. What are they? How do they work? Mm-hmm. The first impression is, the banks are the only ones that hold the notes type thing. And so I started doing some research and got involved with some different groups and started to learn kind of what they were and how you could access them, kind of the difference, like there's performing, non-performing, and then you get into the nuances between those two, because they're completely different type animals, as you guys know. And so I guess it was almost 5 years ago, I took my plunge and got my first note, and started. I actually started off. I wanted to learn with somebody that I thought knew what they were doing, so I jumped in a joint venture, and I jumped in with the wrong person, and so that didn't turn out well at all. It ended up with me having to basically take the notes back to avoid lawsuits and all that kind of stuff. So, which I did. But then, I started working through them myself, and with, listening to a lot of different people like this, and other people, other professionals, you learn a lot. And once you start doing it, I can't emphasize enough that, you learn by doing a lot, when you start doing it. Just, you got to pull the trigger. And so anyway, I started moving forward. I really enjoyed it. Doing the economics on these things were easy for me, that kind of stuff. And so it's a matter of, finding them, evaluating them, and seeing if they're a good fit, and then understanding kind of what you're buying and where you should and shouldn't be buying, and, all those kinds of things that you basically learn as you go along. You just don't wake up in the morning and know all this stuff, at least not me. It takes me a while to absorb it. So that's kind of how I got to notes. And, the other thing I find is that kind of once you get into space, it's kind of it's a niche group of people. And once you get to know them and they get to know you, I really enjoy working with the people in the note space. They're really, there's obviously some exceptions, but they're really a good group of people that, I enjoy interacting with and working with. And, even though you may not be able to agree on a particular note that you're selling or buying or whatever, that's just today. Tomorrow you'll be working together again, because that's what you do. It's not like it's something personal, because if you start making it personal, then you're going to be making the wrong decisions for all the wrong reasons. Is my experience. So that's kind of where I got to today. And so
it was kind of forced upon you, but you took it on and and just took the bull by the horns.
Well, yeah, I learned because I was sitting watching nothing happen, they were non-performers and nothing, there was no action being taken. And so 18 months later, I said, hey, I'm done just sitting here watching nothing happen.
Mm-hmm.
We need to take some action. And so
that's good.
How you move along anyway.
Yeah, no, that's good. And then coming from a finance background, we talked to everybody. I think Dave and I included, we all came from a real estate background.
Right.
So coming from a finance background in a lot of ways is a huge plus, because that's really what this business is about, is finances and numbers.
And people get in a space like, I don't want to mess with numbers. I just want to buy real estate. And it's like,
right,
you're doing both.
Yeah. Well,
yeah.
If you want to donate money, it's a good place to do it.
Sure.
Yeah. It's a shame, because it's a lot of people get into this stuff because of landlording, right? And they just get they get bored of it, tired of it, the struggles, the headaches.
Yeah.
I know it's a little bit, it's still real estate, but it's just not dealing with the tenants.
Right.
But there's more than just the house, right? You're not doing REO rehabs. There's numbers. This is a bank versus being a real estate owner.
Right.
Yeah.
Right.
So different look at the numbers. And then you said you got a preparation. Yeah. You prepared a presentation for us on numbers.
Yeah. If you want to, this is a cure for everybody who has insomnia problems, because we're going to talk about numbers. And I have to say that this isn't the introductory course. It's just kind of a little more advanced that we're going to be talking about. So, hopefully if you have some exposure to doing some notes or whatever, this might be a good fit for you. We will get into some things that are normal when you get into buying notes and stuff. So, it's some things you should know. So if you want, we can jump into that.
Let's jump in. So Joe's going to bring us on to learning about the differences, right? This is the idea here today is there's multiple ways to calculate your returns.
Mhm.
Now, there's some simple ways and more complex ways. And you may say, well, I just want the easy way. Sometimes the easy way is the wrong way and gives you a fake return. Sometimes the easy way can give you a roundabout idea, right? And there's some ways that are just a lot more complex that can be overwhelming. So hopefully that
Right.
kind of helps.
Right.
So
I'm going to start out about, talk about understanding the returns on notes and kind of a good way to calculate that, because that's what it's all about.
Mhm.
So a lot of common questions, some people say, well, isn't the return just the interest rate on the note? I mean, if it's 5% note, isn't that my return? Well, if you paid the full unpaid balance, yeah, that would be, but I don't think a lot of people want to pay the full unpaid balance. Plus, you have all these other things that jump in, like, what the legal balance, because, that's another part that you need to consider, depending if they're behind and all kinds of stuff. And so, then the other question is, they have all these acronyms. What do they mean? What's ROI and IRR and XIRR and yield and NPV and XNPV? Golly, your head just swims with all this stuff. And, so, okay, how do I know which one is the one I should be using when I'm looking at this particular note? Well, I'm going to just quickly go down. I'm not going to go. I thought about actually showing the mathematical equations for these, but then we would all be asleep, myself included. Okay. So we're just going to talk about what these particular formulas do and how they apply. Most of these, not all of them, most of these, because I like to use Excel, and a lot of these are Excel functions that you can use in an Excel spreadsheet. So, you can use them there, but the ROI, return on investment, is just a total net profit compared to your cost. Tends to be backward looking, and it includes asset appreciation. Well, asset appreciation doesn't really apply to a note because your note doesn't really appreciate. Now, if you're talking about real estate doing, looking at ARV values and all that kind of stuff, that's another dynamic. But if you're just looking at the note, it doesn't appreciate. So that doesn't really apply here. And there really isn't an Excel formula for ROI.
let me make sure people understand it. You can use your calculator, the fancy calculator everyone uses, but you can also use spreadsheets to calculate the same returns. So that's what you're saying, is that there's people out there push the calculator, right?
Yeah, like there's a calculator. You can use that, baby.
You can use the calculator. But what Joe's talking about is you can also use, which I use, spreadsheet formulas to equate the same numbers so that you can put this alongside of any asset, any tape, and get the returns right on the spreadsheet in a quick formula. Sorry, Joe, go ahead.
Yeah. So Dave, who has a calculator that can do that?
Many people.
You included, right?
People, yes. So many of the people who are been in the space for a while or old timers use the calculator, right? And we have one, and it's great on the fly. So yes, we have them.
Yeah. Yeah. No, you have a good one. I know. I'm not talking about the handheld calculator. I'm talking about the Excel spreadsheet that you've got.
Not many people use the spreadsheet, but you and I both do, and it's easy for us to calculate deals.
Yeah. Oh yeah. Yeah. That's I only use the calculator if I don't have my computer handy. Otherwise, it's always Excel. For me. Anyway, IRR is internal rate of return, and it's for a series of cash flows, which relates a lot to our notes because that's what we're looking at. We're looking at a series of cash flows. To do IRR, they have to be equal. In other words, you're getting the same payment each time, and it has to be at the same interval. So you have to at least receive one every month or every quarter or every year to be able to use this particular function. Now, the XIRR, that's the internal rate of return. It's for a schedule of cash flows that aren't necessarily periodic. Now, we tend to have more periodic ones. I mean, if you just strictly look at the note, But if you think that you're going to get multiple payments at a certain period of time, or you think you're going to get an early payoff or whatever, that's when this comes in handy. My only problem with it is that's hard to forecast when you're forward looking. I mean, you don't really know. My expectation on most of my notes is that, they're a monthly note, but you can use that, and you can also use it in backward looking, because these are the kinds of payments that I ended up getting. Rate function is just the interest rate per period of the loan that you've received on periodic equal basis. Probably one of the most used ones that I use is the rate function. All of these four, they're going to give you a percentage. So you're going to end up with a percent that says, okay, this is the percent return based on these particular criteria that you put into that equation. You can also use the NPV, or it's the net present value, and that will tell you what all those cash flows are worth today. And a whole lot of this is based on basically the present value of money. It kind of goes back to the principle of $1 today is worth more than $1 tomorrow. And I think we know, if we looked at the news, the dollar today is 7% less than $1 was last year because of inflation. And so that's what this is trying to tell you, is what the value of it is today, based on whatever, we're seeing on the news at 7%, but you can put any figure in if you want your discount rate and determine what the current present value is. Right. And the net present value function, that's for just a schedule of cash flows that's not necessarily periodic. Maybe you get one today and one in 2 months, and however, in my corporate function, we would use this a lot because we were looking at projects, and projects have, a lot of varying cash flows over time, depending on your expenses and your revenue and all that kind of stuff. Whereas notes tend to be, more consistent. Now, you can have some notes that, have some nuances, and that's where you can play with those also. But those, in at least my experience, tend to be more of the exception than the rule. So when do I use them? Like I said, ROI, I kind of use it. I always, after I sell a note, I like to see, how did I end up doing? Did I get this one right, or did I miss something? And so I do kind of a post appraisal, if you will, and an ROI is one way to do it. After I sell a note, I can see, well, how did it perform? And I take into consideration, my purchase expense, my due diligence expenses, my servicing fees, if I had forced placed insurance, my legal expenses, the payments I received, sales expenses, and all that to see, what kind of return did I end up? And what I like to do is, because when I buy a note, and I think most of you guys do, you calculate what you think your return is going to be on it when you buy it. And then when I sell it, I go back and I calculate to see, what did I really get? And did I get more or less? What was it about on target, or were there some surprises? And there's always surprises, and there are some ones that are kind of standard, but there's always some surprises that pops up. So I do that kind of for a backward looking purpose. The IRR and rate, they're the ones I most often use when I'm preparing to a bid. And so notes, like I said, they're based on periodic consistent payments. And, if they're all the same, you can use the rate function. But that doesn't mean that I don't take into consideration servicing fees. I don't, I do take that into consideration. I do take into consideration things like my due diligence expenses. And I also take into consideration the purchasing costs, the boarding costs, all those kinds of things when I go through that calculation.
Yeah.
And so, Joe, I don't typically interrupt, but one of the questions was, what do you mean by rate? What is rate?
Rate basically is going to give you a percentage. It's your rate of return, if you will.
Annual rate return. It's your return. You figure out.
It's an
ROI is a simple one, right?
And is
Over
that
5
different-
years, your annual return.
And
Right.
is
It's
that
an annual
different from
return.
yield?
It's based on an annual basis.
Right.
Some people, it's interesting. Some people call it yield.
Mhm.
Mhm.
Some people, but if you go and you look at the Excel formula, there's an Excel formula for yield. The yield formula on Excel basically is structured to determine the yield on a bond. And a bond is a little different than what you get, because a bond, you end up, it's got to pay off at the end, and the variable in the price of what you paid for it. So the components for it are a little different than for a note. So what I find is that the rate formula in Excel is a better application for calculating this. So when I say rate, a lot of times people use that term interchangeably with yield. And what that means is it's your annual rate of return.
Yeah.
You can also use the I on the calculator, right? For those using the calculator, it's the I, where these correspond in the time value calculations. It responded to there's actually letters on the calculation that there's I, there's N, there's NPR, constant with that. So you know what you're using. Rate is a term we use because it's an equation in our spreadsheets, right? Where on the calculator, it's an I function. So it's a return annually. So yes, so you can use the word yield, but what we're looking at the fact that the annual return can be a yield, could be an IRR, which are completely different calculations. We're going to get into that in a few minutes.
And then, like I said, XIRR, that's just, like the IRR, it's just with if you have inconsistent payments. So what I did is put together a little sheet to say, okay, what's the difference between these things, and what are the parameters that you have to have in order to be able to calculate that? So yield or rate, if you want to calculate that, you have to have equal payments at an equal interval, and then that will give you a percentage return. If you want to do IRR, you'll look, it doesn't have to be equal payments, so the payments can be whatever.
When we make sure clear, when he means regular, meaning the same time, same month, same amount, right? It could be different amounts. That means it's irregular, or different clockwork. Yield is the same, the first of every month.
Right. That's with yield. On the yield one, yeah, you've got the first of every month, and you got the same dollar amount. Cha-ching, cha-ching, cha-ching. Now, if you have a situation where I'm trying to think where you don't have equal payments, I don't know. There probably are some loans that might have variable interest rates, and if you know if you could predict them, and okay, the rate or the payment is going to go up at a certain period of time, but it's going to be every month, the payments are going to be made, then you can use that to calculate what your return is.
Or if payments are every other month and the borrower is not consistent, you can use the IRR.
Yeah, exactly. Yeah. The problem I have is I can never forecast that.
Yeah,
correct. So internally, we use IRR for another way, is that payoffs, right? Yield that goes to a maturity date, where we're using IRR to say, I'm going to sell a loan in 3 years. Or if there's a payoff in 5 years, it's not going to go to maturity date. So we use IRR to say, I'm not going to hold this for 20 years. Where yield calculates to maturity bond, right? To 20 years down the line, and says, what's your return every single year till the maturity date?
Yeah.
Right. Yeah, because I use something similar like that, because one of my exit strategies is if you take a non-performer, you get it reperforming and you sell it. That's a potential exit strategy for my non-performers. And I also then calculate, well, what price can I sell that at based on what I think the buyer is going to want as a yield. And based on that, I can calculate the sales price.
Yeah.
And then you can put that in to determine what your rate of return is going to be. So you're right. You would have consistent payments until the time you sold the note. Well, if it's non-performing, you won't necessarily have consistent payments, but you hope you would after a period of time. Payments. And then you'd have the lump sum payment when you sold the note, and then you could calculate your return.
Right.
And so it was just I just kind of put it together. I hadn't really looked at it from this perspective, but it kind of makes sense where what you can use in a particular situation to give you your return, either in dollars or the percentage amount.
Right.
You know, when I first started out, I was exposed to some people that were suggesting that you ought to just bid as a percent of UPB. Just, make that your basis for your bid. And kind of always thought, why that doesn't sound, it sounds strange, but I was a newbie, and thought, well, maybe they had some other things, some experience, or there's always shortcuts that people have, and figured this was kind of a nice shortcut. So I thought it might be interesting to kind of look at some examples of a comparison of if I bid based on UPB percentage, or if I bid based on what I want my yield to be or my return. Okay, so I thought I'd put you two guys to a test.
Ooh-wee.
All right.
So here's what we're going to do. Here's the basic assumptions for a bid. Okay. All the notes that are going to be presented, they're performing. Okay. So you can put that category there. All the UPB bids are going to be bid at 90%. So I think that sounds kind of like what a lot of people who are bidding UPB bid for performers.
Yeah.
And as a yield bidder, somebody who wants a return, going to be somebody who wants a 12% return. Okay. Might be a little high. I think some people have lowered it a little bit, but
not high.
For this exercise, we're going to use 12%. So
all right.
Here's what's going to do. We're going to have 3 notes that are come up. UPB bid is going to be 90%, and the return is 12. Now here's the first one. The UPB is 50,000. The interest rate's 9.5%, and it's got 163 payments left. And the payment is $546.56.
All right. There's
okay. Mine. You're cheating.
I'm a calculator guy.
So we already know the UPB bid on this one's 90% of 50,000 is going to be 45,000, right? So right. Boom. You didn't need a calculator for that one.
Nope.
That's an easy. So the question is, the yield bid, the 12% yield, is that bid going to be higher or lower than 45,000?
Let's see it from the audience. I know that probably a little bit delayed, but so the question is, will the yield go up, or will the return, will they go up or will go down?
Right. Because the return, you're going to bid on a 12% return. Yeah. So is your 12% return going to be a higher or a lower bid than 45,000?
If you want 12%, what I get is if you want 12%, you're going to have to bid lower than 45.
Okay. You say lower. You agree, Dave?
You're going to have to bid lower.
Yeah.
Okay.
Let's find out.
Yes, you are. You're going to have to bid lower if you want a 12% return. So the good news, okay. So now let's look at what is the yield on the UPB bid. When you do the calculation, if you bid 45,000, you can tell, do you know the answer, Nathan? You want to guess? Of course, I also included costs for the servicing and all that kind of stuff. So that might, but
if I just put in just a straight 12% yield without any additional expenses in there, the bid's going to be 43,860.
Right.
22 cents, but that's without any additional expenses in there.
Yeah. Cause this bid that I did, it includes about
a net bid.
Yeah. It's a net bid after $30 servicing, after close to $500 in expenses. When you consider, the cost to acquire it, you consider your due diligence, you consider recording fees, all that kind of stuff. But anyway, so the yield that UPB guy is going to get is going to be 10%.
Make sure you guys don't know this. This is based on 0 servicing fees, right? This is a gross yield. Just FYI.
No. This is a net.
No,
yield.
this is net.
This is a net yield.
Okay. Oh,
This is
okay.
net. This is after servicing, after your acquisition costs, all that
Gotcha.
kind of stuff. So, so they're apples and apples with the 12% return and the UPB return of 10.
Right.
So this bad news in this situation is I lost the bid because I wanted a 12% return. I only bid 40,568. The UPB bidder bid 45,000. They got the bid, but they're going to get a 10% yield. They're not going to get the 12, which I was hoping to get. Okay. So I lost that one. Let's go to the next one. Sorry, we knew the return yield was 12 because that's what we based it on.
Yeah.
Right.
All right, loan 2. It's got the same UPB as the first one,
Okay.
50 grand. Interest rate's 3%. It's got 104 payments, and the payment is still the same, 546.56. Now we know that the UPB bid's going to be the same. It's still 90% of 50,000 is 45,000. So is my bid to get my 12% going to be higher or lower than 45,000?
It's gonna be a lot lower.
We'll give it a little pause for Facebook catch up. So again, Joe, just so people were kind of lost, explain it again. What are we trying to figure out? What are we solving for those people?
Right. We're comparing for those people that just bid on a UPB, as a percentage of UPB, because some people do that. I mean, I was originally taught to do that.
Yeah, we all were.
As opposed to how you would bid if you base it on a given return, what your required return is. Okay. And then in this example, I said, okay, well, we'll look at a bid based on a 90% UPB bid, as opposed to a return that I want to get a 12% return. So I'm looking to see how this UPB bid is going to compare to my bid that I want to get a 12% return on. And will I win or lose the bid? And if I win or lose, how does my yield, which is mine's based on 12%, how is that going to compare with the yield that the person got when they won the bid, like in the first case, when they won the bid for their 90% UPB?
Right.
And in that first loan, like I said, you can see that to get my return, I had to bid less. They bid 45 based on the 90% UPB. I only bid 40,568 because that's a 12% yield. But at the end of the day, when you compare, well, what yield did they get compared to what I wanted to get? Well, they would get a 10. And of course,
and
I would
more
get
than
12,
likely,
that's what mine was based on.
because more than likely they bid strictly on percentage UPB. They probably didn't calculate the return.
No, they didn't. They didn't. No, they just did it. And so my objective was to see, well, what return would they get? What do you really get?
And they're going to be
that was
frustrated.
what loan number 1 was. So loan number 2 is the same scenario, only what you're seeing is you're seeing a lot lower interest rate. You're going from a 9.5 interest rate on the note to a 3%. Now, I still want to get a 12 return on my note, and they're still going to bid 90%. So what do you think?
They bid 45,000. What do we have to bid? So they're bidding 45,000, and we have to bid here based on our 12% return.
Right.
I'll do a little, circle thing. Right on that 12%. What do we have to bid to win to get our return?
Right.
Yeah. What do you have
So
to
I've
bid?
got the gross
What's
number.
the bid to get your return? So you think it's
And they
higher
bid
or lower?
45.
Huh? You
The
say it's
question
lower,
is-
right?
Yeah, much
lower.
lower.
Yeah,
much
exactly.
lower.
Much.
That's what you have to bid. That's what, to get that return, that's what you bid.
Yeah.
You bid 32,461. And the reason why that's so much lower is because the differential between the interest rate and your return.
Yeah.
This note only has a 3% interest rate. That's nothing, relative.
Yeah.
It's something, but it's not much. So in order to make up that differential and get my 12% return, I have to bid a lot lower to get that return.
So understand that you can look at two loans, identical numbers, and with the interest rate changing, we talk about this in our weekly mastermind group, that changes your bid dramatically, no matter what the UPB stays the same.
Right.
So
Right.
understand that the interest rate, you can't ignore it. You have to look at it.
That's why in all these examples, I kept the UPB the same and I kept the payment the same.
Right.
It's going to be the interest and the number of payments are the ones that are going to wobble. So, you know, what kind of return does that UPB bidder get?
So we're going to say, what did the return, the person who bid 45, we're solving for the I or the annual return, right? What are they getting?
They're going to get a 3.7% return. And what would we get if we won the bid? Well, we get 12% because that was what the whole thing was based upon. So far, I'm not doing very good bidding. I'm not getting any of the bids, but by the same token, you know, I'm not ending up with a 3.7% return either.
Right.
Yeah.
So
I think you're right.
We'll go to the
It's
third
not
case. This one.
Yeah, let's do it.
So now the guy that's getting that 3.7, unfortunately, they're going to find out that they're very frustrated with notes as a investment. They're going, well, this thing is stupid and it doesn't even make any sense. I'm not making any money. You're right.
Exactly.
I think I can help your problem. I'll be an idiot just like you and I'll buy it from you. Right.
There you go.
So here's the third one. This one's a little trickier.
Ooh.
The UPB is just a little bit larger. It's 51,000 to 11. The interest rate's 12.5%. There's only 12 payments left because this is a 5-year balloon. It was amortized for 360, 30-year amortization with a balloon at the end of 5 years of 50,102. So basically you are going to get 12 payments of the 546. And then after that, you're going to get the balloon payment. So now we know the UPB bid is again 90% of the 51.2. So that's the 45,341. Now, what are you going to bid, higher or lower?
What's our going to do for delay? You're bidding higher or lower than the UPB bidder? We'll give a, I know
Are you
about
bidding
30 seconds behind.
more than the 45,341 or less than the 45,341?
Dun, dun, dun. Right. We're solving, we're putting our interest rate in, we're putting in the payment, we're putting in the balloon. Right. And we're solving for what is the PV, right? Or rate equation, or the PV, the formula for PV. So we're going to pay higher than the UPB, than the UPB bidder.
All right. I hear one higher. You, Nathan?
Higher. Yep.
Ta-da!
Yeah.
You definitely are going to bid higher. Time value of money, you're going to be getting that balloon payment early. You've got a 12.5%. So the interest on the note already is higher than what the yield you're looking for.
Yeah.
You know, so you could bid 49,781 and you're going to win the bid compared to the UPB person. And you're still going to get your 12%. The UPB bid, if they got it, they'd have like a 20% return, which is nice. I mean, you'd like to get that one, but
all day.
If you're bidding against me, you're not going to, you know. And of course, our return is 12%. So that's just kind of examples of different types of notes, how the interest rate definitely has an impact on what your return's going to be, and how the present value of money, because you're getting a balloon much earlier than waiting the next 20 years to collect these payments, are going to help your return. That all affects what you want to look at and how you calculate it using these different parameters. So congratulations, guys. You passed with, I have to give you each one of you guys a star for the day.
I like it. A little sticker. I like it.
So
what do we learn from this situation, right? we're learning the fact that if you're bidding based on BPO or UPB and ignoring all the other numbers, your return is dramatically different than if you use math. And why it's essential to use math? Because if you don't, you can end up with a 3.7% return.
Right.
Because you didn't calculate it. So you may not understand it, but you must understand it if you want to be successful.
Learning.
Right?
Yeah.
So let's keep that on the screen for a few minutes. Let's talk about a little bit more about real quick about the balloon, right? Can you explain, Joe, what is a balloon for? Why is it there? And how does it change the number? Like, what does it do, right? Not mathematically, but why is it changing? If that was a zero, it'd be a totally different situation because it's a different loan.
Right. Well, a lot of times the practical application is a lot of times what I've seen is you can see some balloon notes or situations where people who maybe they don't have good credit when they're getting the loan. So they end up getting a loan that has a higher interest rate that, lender will lend them a higher interest rate, and they'll agree to a balloon because what they want to do is they want to improve their credit rating, which will then allow them to get, more of a commercial type loan at a lower rate. So they're going to refinance it. So they'll pay it off the balloon and refinance at a lower interest rate. And I've seen that, happen with lots of different situations. There's also the situation where they get to the balloon and say, no, we can't do it. Can you extend it? And so then you have, recalculate, okay, we'll extend it and see what the payoff is. And that's another exit strategy you need to really consider, I think, in one of these, because you need to see what your return would be if you did extend it. But the benefit of the balloon, that's theoretically, that means in 12 payments, they're supposed to pay me $50,102. So that means in 12 months, I'm going to get that 50,102 plus I'm going to get that 546.56 every month for that 12 months. Well, the fact that I'm getting that so early is very beneficial. And so that's the reason why I can bid more, because of the present value of it is greater than if I had to wait for, 280 more payments. And again, it's the time value of money. The further out you go, the less that money is worth, is basically what it is. And the fact that you're getting it earlier means it's more valuable.
That's great.
Money today is worth more than money tomorrow.
Absolutely. Absolutely.
That's a really good lesson for everyone to learn.
Yeah.
You cannot just look at a percentage of UPB. I think, if you go back 10 years ago when everything was underwater,
right, even
then it didn't make sense. But I think that what we heard a lot back then was bid on a percentage of UPB or value, whichever is lower.
Yep.
Mm-hmm.
So it made a little bit more sense back then, but only kind of.
And I think it made sense because we couldn't screw up. I think that's what it comes down to.
That's really what it is.
You couldn't, when you're buying it so cheap that, you're wrong, but who cares? They're all getting similar returns.
Right.
Yeah, that's true.
Yeah, that's true. That's a great point. Today, I mean, I jumped in after the 2008 and all that kind of stuff. So, I don't have quite that experience that you guys do, but now you need to figure it out. The good thing now though is, and I heard this, I think
we're losing his audio. I think we're losing his audio.
Coming back.
Come on, we can do it.
in there when you're buying notes.
We lost you for a second or two, man.
Yep.
So I wanted to show people, right? I did something similar, but I wanted maybe you can kind of see. Let me see if I can find it real quick. We're on the fly here. Let's see if I can.
So Cody asked a question there about, are we finding that sellers are more looking at a percentage of UPB, or are they actually looking at yield calculation? I'm not sure about you guys. My experience is they're more looking at yield calculation. I don't know about you guys.
Yeah. Yield calculation
I'm kind of seeing a mix. I'm seeing some sellers wanting to have particularly underperforming, it's like, oh, we want 100% of UPB.
Yeah. Dave and I looked at a couple weeks ago where they wanted a premium. They wanted 101% or 102%. And we ran the numbers and they just really didn't make sense.
Yeah. So I'm going to share with you guys. So for those that may be a little confused a little bit, I'm going to show you a side-by-side comparison of what, and I'm sure I've shared this before with you guys, but me, hope everyone can see that. Okay. So we have a situation where we have a coupon rate of 3, right? UPB, if we bid 60%, right? Look at the difference in returns, right? Because of the interest rate on the coupon, the original coupon. We bought it at 30, the change is dramatic. We changed payments, it changes dramatic, right? So the UPB stays the same. You change this number or this number, the change is dramatic of what it is. So we got to be careful being simple with things. So, let's open for some questions here. Let me bring this.
And I like simple. I'm a big advocate of simple. However, you do need to know what you're doing.
I agree with simple too.
Yeah. But, even I've had people ask me before, well, do you need a financial calculator? But if you're not using a spreadsheet, then yes, you do need to know how it works and how to plug the numbers in and solve for X. And if you don't, you better learn it, because you'll get yourself into a real world of trouble if you're just using a regular calculator to try to figure stuff out.
So one of the things, Cody, I think we talked before about this, is that sometimes sellers are not selling based on yield or ROI. Big funds do, right? But some people, hey, Joe, I'm going to buy an asset from you or whatever. I'm going to bid this, and you're not a sophisticated investor. You may look at your basis and say, hey, I'm here. I'm doing greatest loan. I owe you $4,000 to break even. And you want to buy for 20? Done deal. I get out and I'm moving on to a different deal, right? I may be in that position where that was what we did at one point, is we went based off our basis. And if we could sell it, if we're completely in the black here and we're in infinity return and you want to buy it for 10 grand, it just adds our thing, right? So some sellers do that. I don't agree with it, but they definitely can do it, right? So making sure when you bid on things, and you can put this formula inside your spreadsheets when you get them and run it down the entire list. And then that could be a filter, right? I tell my mastermind guys, every time you get a tape, some of the best filters is just to take away the low interest coupon rate loans. Take them out, because you're probably not going to turn a 2% into a 10.
Right.
You're not going to.
Yeah.
So
another thing that I noticed too, besides the low interest rate, is a lot of times loans that have a small monthly payment. When you start deducting servicing fees from a small monthly payment, that becomes a significant percentage reduction of what you're going to receive. $20 as a percent of $100 monthly payment, as opposed to a $500, that's a significant impact on your return.
Absolutely.
That's another way to filter, right? We all talk about states and all stuff. You may filter by interest rates above 6 and any payment that's above 200, and eliminate anything else. Because if you're paying $20 a month, or if it's not performing, you're paying 95, whatever you're paying, it's crazy. So yes, you may be able to filter doing this process, and sometimes I do. If I see 2%, if I get a tape in and it's all 2%, I'm not gonna bother.
No, neither.
No.
It's not, the math won't work. right? And that's
No,
one
and
way of doing it.
you end up
unless
picking off the
unless you have a
seller.
seller that really has to sell.
Yeah.
Yeah. So,
Otherwise, you just tick them off because they're like, "What is this? What is this garbage bid?" Well,
Yeah.
so I don't know if you know the answer. Cindy asked a good question, and this is hard because this fluctuates so much. Can we accurately account for inflation? I don't know of a way of doing it.
that's over my head.
No, I mean, I would tell her that if you could, let's talk because we can make a lot of money.
Oh, I like that. So yeah, someone asked in the group about what the formula in Excel is for rate. For those who will be listening to the podcast later, =, rate, open parentheses, and it actually tells you what to put in additional spots.
Exactly. Yes.
It's nice and simple. And I'm gonna tell you guys, I used to use a formula called dated if. I'm gonna encourage you guys to use the MPER formula to calculate how many payments are in the loan, right? Right, the number of periods inside that situation. So it gives you an accurate, because if the UPB is wrong or something, it's going to give you an error. And you may go back to your seller and say, hey, listen, the numbers aren't making sense.
Mhm.
Oh, it's a balloon. Oh, okay. Right. So all these formulas have it. Yes, you can use a calculator or you can use a spreadsheet. I'm a spreadsheet crazy person because I can process 100 loans in a minute using a formula where a calculator takes a little bit longer.
Yeah.
And I'm only looking at, if I'm looking at 20 loans, I don't mind doing that by hand. I could get all fancy and use your spreadsheet, but for 20 loans, it's not a big deal. I don't mind going through and plugging in the numbers and just seeing what they all work out to individually. So
this is a good question. The ask was, if you use a formula inside Excel, right? And I'll put it into the chat so you guys can see it too. Will the future value always equal 0? So I want to make sure we're clear. Future value is a balloon value, right? But you may be talking about something a little bit different. So balloon value doesn't always equal 0. It depends on if there's a balloon or not. Mm-hmm. However, there's another function right after the FV, the future value, 0 or 1, meaning is it the beginning or the end of the loan? So is the balloon the beginning or end? So most likely, I don't know of any loan I've ever bought where the balloon is the beginning, right? Usually have balloons at the end. So hopefully that helps.
Balloons are not super common, especially if you get anything established after Dodd-Frank. They're not common at all. So don't get too hung up on it. It's important to know how they work and when to use those calculations, but you don't see them a ton.
If you do a balloon, make sure you record any mods you do with them, because that it can change your maturity date and stuff. So but yes, good question. So yes, you can do a rate formula in Excel. Google Sheets is sure, I use all the time. Same idea. And I run this calculation. I have a spreadsheet. For those who bought the beginner series, I actually have a yield calculator that I can share with you guys. You can run through assets through that way. So awesome. If you have any more questions, feel free to let us know. Joe, when you came into space and ROI was what you did and your percentage of UPB, did you have an aha moment where like, holy crap, I'm not getting the return I thought? Was there a story that came along with like, uh-oh?
No, I mean, like I said, based on my career experience, I didn't really have that. I guess the thing that when I first got into JV, the thing that bothered me more than anything was because of the lack of action on dealing with it. The clock is ticking, and the longer and longer the things go on, the more and more your return is reducing.
Yeah.
So, what I knew, but kind of reinforced, is that you need to take action. You just can't sit there and hope something's going to fix it, because the longer it goes on with it not being paid, no action being taken, the worse your return is going to be.
Yeah. It's a shame. So guys, awesome information from Joe. Well laid out too. I do a terrible job laying this stuff out, but it was a very well organized situation to show you the comparison and the effects of it, right? And the different ways a bid, ROI versus IRR. Now, those who are curious about the XIR versus IRR, it's a very similar function. Again, still in Excel, but it really kind of tells you, XIR it compares payment to date, where IRR is a simple payment string, right? And it just takes a payment string, where XIR takes the dates and uses the formula to figure out if it's been skipping months and all that good stuff. So awesome stuff, Joe.
Yeah, thank you.
I think a lot of sellers understand this and a lot of newer investors don't.
Mm-hmm. And unfortunately, for the most part, by and large, I don't think sellers are trying to take advantage. But at the same time, if they're getting that bid that's at 10% of UPB and it's, $5,000 or $10,000 more than your bid, they're probably going to go with that higher bid. And, the seller, honestly, they have to assume that the buyer coming in at that bid is doing it for a reason. So, not that they're out to try to screw anybody over, but if they get offered a higher bid, they're probably going to take it.
Yeah, absolutely. And I think, some courses don't teach it. Some courses do. They don't emphasize it enough. It's not hard to do, and you don't need to understand the exact math behind it.
Mm-hmm.
Just understand that it's your return. And you look at bank statements, your bank account. If you look at your mortgage statement, you can calculate your mortgage as well, your personal mortgage with this stuff.
Oh yeah, absolutely. Yeah.
Cool.
So then, Joe, what do you see coming down the pipe here? You've been around long enough that you can see things as they are. What's your crystal ball prediction here?
I'll be honest, my crystal ball, to be politically correct, is lacking. I actually thought that we were going to see a turn in the market last year. Mm-hmm. And I think that, the continuance of, the moratorium that we had on foreclosures, I think that, the payments that went out, all those kinds of things protracted it. But yeah, I was expecting us, to be honest, to see a lot of non-performers start to hit the market basically in the last quarter of last year. It didn't happen. And now when I listen to people, which is most anybody that's smarter than me, talk about the forecasting and stuff, they're seeing, and I tend to agree, unless we have some more economic easing or whatever going on, that there is this pool that's sitting out there that's just kind of waiting to kind of filter its way down. Mm-hmm. And it's before it gets to little guys like me, it's got to go through the hedge funds and, kind of filter down, et cetera. But I think there's some coming. It's got to be, Yeah. I think the stock market's going to correct too, but don't bet your money on that.
And I mean, we had the question about inflation earlier. Is inflation the trigger? I mean, who knows, right? But maybe.
Hopefully it doesn't get too crazy. But there have been talks about this thing start going up like the early 80s, right? And that's much younger, right? That's scary to hear. And for those maybe even younger than I am, we're not talking like 8, 9, 10. We're talking double-digit inflation.
Yeah.
Right.
So we shall see.
Yeah. It's.
Well, thank you very much, Joe.
Yeah.
We're going to disconnect from the Facebook Live, and hopefully we've given some tools, resources to those people who are newer or just didn't know about this. So, Joe, again, thank you for presenting, coming on, and chatting with us on this Friday afternoon.
Thanks,
guys.
Joe.
It was a pleasure spending time with you.
You bet. Thank you.
All right. Y'all take care.
You too.